And we're talking in this webinar about home equity lines of credit and home equity loans. So there is a difference between the two, and we're going to get a little bit into some of the pros and cons of why some people choose HELOCs over home equity loans and vice versa, as well as some of the things that you need to be aware of and watch out for if you are looking to pull equity out of your home to be able to use for whatever purpose you want to use it for. So we'll get on into it. So if you are not familiar, I'm pretty sure everybody's seen a Venn diagram, but if not, everything on the left side with HELOCs is going to apply just to home equity lines of credit. On the right side, home equity loans, and then the things that are shared between both programs will be listed in the middle. So starting with HELOCs, we've got variable interest rates, which is typically what you find on a home equity line of credit. So that means that the interest rate that you start with is likely not going to be the interest rate that you will see as you continue on with your home equity line of credit. That interest rate will change based on market conditions. So as interest rates are rising, like we've been seeing now, starting back in 2022, your HELOC interest rates will also rise on the amount of interest that you will have to pay on those loans that you take out. So that's something that you definitely want to be aware of when we're talking about HELOCs. Also, a HELOC works as a revolving line of credit. So what that means is that you have a line of credit similar to a credit card. You can charge it up, you can pay it off, and then you can charge it up again. So with a HELOC, typically the amount that you pay for your minimum monthly payment when you do charge money or borrow money rather in a home equity line of credit is just the interest that is owed. So for example, let's say if you take a home equity line of credit out of your home for $40,000, then the minimum payment that you would have to make would be whatever the interest is for the amount that you have taken out in that loan. So if you have a $40,000 home equity line of credit and you borrow $20,000 or you borrow $10,000, whatever that amount is that you're currently have outstanding in a loan balance, that's what you would have to pay interest on. But it works like a revolving line of credit, and you have a draw period and a repayment period. So with the draw period and repayment period, the draw period is typically, it varies from lender to lender, but typically you see a 5-year draw period, sometimes a 10-year draw period. And that draw period is the period of time that that home equity line of credit or that line of credit is open to you. So for example, if you were to take a $40,000 home equity line of credit out of your home, the draw, and you have a 5-year draw period, that means for 5 years, you can charge up to $40,000 on that line of credit, pay it off, charge it up again, and pay it off for up to 5 years. Now, after that 5-year period is over with, that line of credit goes away and it transfers into what's called a repayment period. That repayment period is now the period of time that you're given to pay back everything that you have outstanding. So if you still have $20,000 or $30,000 that you have borrowed out of that line of credit, the repayment period, let's say if your repayment period is 10 years, that's the amount of time that you will have to make principal and interest payments until that remaining balance that you have has been completely paid back in full. So those are things that are specific to the home equity line of credit. Moving over to the home equity loan, we have a fixed interest rate. So opposed to the HELOC, which has a variable interest rate, home equity loans have a fixed interest rate, and you also have a lump sum payment. So the HELOC, as we stated, is a revolving line similar to a credit card that you can charge up, pay off, charge up, pay off anytime within that draw period of 5 years or 10 years, however long your draw period is. But with a home equity loan, if you want to take out $60,000 or $50,000, you will get all of that money in one lump sum up front, and then you pay it back in principal and interest over time. So that is how that works with the home equity loan. So some of the things that are shared between the two, this is a second mortgage on your home. So both a HELOC and a home equity loan are secured by your home. So this is essentially a second mortgage that you're taking out because you're utilizing the equity that you have in your home to be able to get that cash. Also, they require typically higher credit scores than what you would have to simply purchase a home. So to purchase, say, for a conventional loan, you'll need a minimum 620 credit score. Oftentimes for FHA loan, they can go as low as 500, but oftentimes it's better if you have at least a 580 or above. If you're looking to get a HELOC or a home equity loan, a lot of times you'll need a 660, a 680. There are some lenders I've seen that require 700 plus credit scores in order to qualify for these loans, because they do come at a higher risk. And so because of that, to help offset that risk, they want to provide these loans to people that have a better shot or a better chance of paying them back. So they want people who have better credit. With that also, it requires a lower debt to income ratio. So what that means is that, let's say, for example, you make $5,000 a month. Half of 5,000 is 2,500. So if $2,500 would be considered 50% of your income, so we would say you have a 50% debt to income ratio if 25,000 or $2,500 goes out of your income every month to pay off debt. So when you're getting a HELOC or a home equity loan, generally they want a lower debt to income ratio. So if you go to apply for one of these programs and you already have a debt to income ratio at 50%, it's going to be really, really, really hard, if not impossible, for you to qualify, because you really don't have any equity to be able to take on the payments that would be required for you to take out these loans. So if your car payment and your current mortgage payment, if you have credit card bills or student loans, when you add all of that up, if that is accounting for 50% or close to 50%, or more of your total monthly income, is going to be very hard for you to qualify. So really, if you can have your monthly expenses closer to 25% to 30% of your income, that's going to help you out a lot better in being able to qualify to get a HELOC or a home equity loan. Because those debt to income ratios do need to be lower, because again, if you take out a $50,000 HELOC or home equity loan, that's going to come with a monthly payment. And when you add that monthly payment to your current mortgage and car payment, if you have one, and credit cards or student loans, that the total of all of that needs to be at or below 50%. And some lenders actually have lower than 50%. They don't want it to be above 45%. So again, you want to make sure that debt to income ratio is low. So this is a foreclosure risk. I don't want to shy away from the truth that this is a loan that is secured by your home, which means that if you do not pay this loan, the lender could foreclose on your home. Now, if you might be thinking, how is it that the lender could foreclose on the home and I have a primary mortgage that's also secured by the loan? So what happens in this instance, just to give a little bit, because this is getting a little bit off track from where we are, but basically the lender can foreclose on your home and they would essentially step into the position of being the homeowner, and it would be their responsibility at that point to pay off the primary mortgage or to sell their position and as the homeowner in that situation. But because it is secured by your home, the lender for the HELOC or the home equity loan can foreclose on it if you don't pay. So you want to make sure that you are financially responsible and in a position to where you can afford the payments that you could be looking at with a home equity loan and with a HELOC specifically, because those interest rates are variable. And if you borrow a whole lot of money and then the economy goes sour on you, then your interest rate could go high and you could end up having monthly payments that are a lot more than what you would like them to be. So that's some stuff that you want to keep in mind as well. Tax deductibility is another thing that both of these products share. So if the home that is secured by these loans, if the funds rather that you're pulling out in a HELOC or a home equity loan are used to repair, to renovate, or to maintain the home that is secured by these loans, then it's possible that the interest paid on that loan is tax deductible. So if that was a little bit confusing, I'll try to explain it a little bit better. In essence, if you were to take money out of your home in the form of a HELOC or a home equity loan, and you use that money to make repairs to your home or to make updates to your home, then if you're using it for the home that you pulled the money out of, then again, it's possible that the interest you pay on that loan can be tax deductible. So you want to make sure that you keep your receipts and everything for when it comes time to do taxes so that you can get the deductions for the interest on that and pay less in taxes. Typically, you will have lower rates than on unsecured loans. If you're not familiar with what an unsecured loan is, an unsecured loan are loans such as personal loans, your credit card, for example, that's an unsecured loan. And by unsecured, that simply means that it's not backed by anything that the creditors can immediately come after. For example, if you don't pay your credit card bills, they can't foreclose on your home because your credit cards aren't secured by your home. If you don't pay your personal loan, they can't come and repossess your car because your personal loans aren't secured by your car. Your car note is secured by your car and your mortgage is secured by your home, but your credit card is not secured by anything. So because a HELOC and a home equity loan are both secured by your home, typically you do have lower interest rates than what you would find definitely in credit cards, which I think the last time I checked, those interest rates were floating around 20% on average for credit cards. And you could find 14% for personal loans. I've seen them down as low as 11%, but I've also seen them as high as like 15 and 16% as well. So it all depends with the personal loans, but typically your secured loans, such as your HELOC, your home equity loan, your mortgages, your cars, those secured loans are going to have lower rates than unsecured loans. Also, you can use these loans for any purpose, and literally any purpose. So that applies to both HELOCs and home equity loans. Again, you can't deduct the interest that you pay for any purpose that you use it for. If you go and buy a boat, you go and take a vacation with the money, you can't deduct the interest from all of those things. But if it's used for the home that you took the loan out on, that's the situation in which you could possibly deduct the interest that you pay from your taxes. So something to keep in mind. And lastly, again, and you'll hear this throughout the presentation, this requires financial responsibility. You want to make sure that you are responsible enough to manage your finances in a way that allow you to make the minimum monthly payments that need to be made, whether it's a HELOC or a home equity loan. So definitely want to be responsible because we don't want anyone getting into any financial binds or any hardships because they borrowed more than what they were able to pay back reasonably based on their income situation. So moving on, which one is better, HELOC or home equity loan? The answer to that is it depends. It depends on your situation. It depends on what you're using the funds for. It also depends on your tolerance level with having a variable interest rate mortgage versus a fixed rate mortgage. So it depends on a lot of things. So rather than telling you which one's better, I'm going to explain the situations in which people prefer a home equity line of credit, and then I'm going to explain the situations under which people prefer a home equity loan. So starting off with the home equity line of credit, people choose HELOCs when they're not sure of how much money they need or when they'll need that money. And they also sometimes choose that when they want lower payments during the draw period. So to start from how much money they need, again, the HELOC working as an open line of credit. If you don't know what you need, people will often take out that HELOC and they will have that open line, whether it's a $20,000 or $50,000, $100,000, whatever it is, the amount of that HELOC that they take out in equity in their home. Sometimes people just have that sitting just in case they need it for whatever the reason may be. But if they don't know how much they'll need, or they don't know when they're going to need that money, then these are situations in which you may want a HELOC. Because again, when you get a home equity loan, that's just one lump sum that you're going to receive, and that's it. So if you were to take out a lump sum of $50,000 and it turns out you're like, oh, I needed $60,000 or I needed $70,000, you can't just go and up the amount. You have to take out another loan to cover that missing piece that you didn't have. Or if you took out more than what you would need, then now you have more money than what you need. and you want to check the terms of the home equity loan that you're getting to make sure that there's no prepayment penalties or anything like that, and you can pay back that money however soon you would want to pay it back. But these are things that you want to be aware of, and these are some of the reasons why people choose HELOCs, is because they might not know how much they need, or they just want to have money on the sidelines for emergency purposes. So maybe they have a 5-year HELOC or a HELOC that they've taken out of their home with a 5-year draw period. So for the next 5 years, they've got $50,000 that they can tap into if they want to. So some of the reasons why people choose home equity loans, people know exactly how much they need. So if you have renovations that you're doing to your kitchen, you want to renovate the kitchen or the bathroom, or you need to repair something on the house, or maybe you're building an addition to your house, or you're doing something where you know how much money you're going to need. In those instances, that's when a lot of people tend to choose the home equity loan, because they're like, okay, I know I need $48,000. Let me just take out what I need, and then I'll pay the principal and interest back over time. People want a fixed monthly payment. Some people don't have the stomach for the adjustable rate mortgages, because you don't know what the economy is going to do. If the economy turns well, then your rate could be going down. But if the economy turns bad, then your rate could be going up, and you could end up paying a lot more than what you want to pay. So it can work in your favor, or it could work against you as well, all depending on the economy. But people that tend to want that fixed monthly payment, even if it is a little bit higher than what the HELOC is, and a lot of times, particularly at the beginning of these loans, when you pull them out, a lot of times the home equity loans will have a slightly higher interest rate than what you will find on the HELOCs. And again, that's because of the variable nature of the HELOCs. They generally do start off lower, and where they go from there is all based on the economy. So they can very well go past what a home equity loan is, but they could also stay below what the home equity loan is. So it's kind of a roll of the dice there in terms of what you might get with the HELOC. But again, it's that open line of credit that you have that you can tap into when you need it. Also, there's less tendency to overspend with home equity loans. So you have to be disciplined when you get a home equity line of credit, because let's say, for example, you're pulling $40,000 or $50,000 out of your home to utilize for whatever purpose you want to use it for. If you know that you've got $40,000 or $50,000 just on the sidelines that you can utilize at any point, and you're undisciplined in your spending, you will eat through $40,000 or $50,000. And then particularly if you do that at a time when the economy starts to go south, you could end up paying a lot of interest on that $40,000 or $50,000 in a home equity line of credit. With a home equity loan, your payment's going to be the same regardless of what happens to the economy. So that's one of the reasons that people do choose the home equity loan. Particularly, they don't have that tendency to want to overspend, because again, you get the one lump sum, that's it. Now you're making the same payment over the next 10 years or 15 years or whatever the repayment period is for that home equity loan. So these are some of the reasons that I would consider when you're deciding whether or not you want to go the HELOC route or the home equity loan route. Is, what is the purpose that you're going to be using it for? If you're looking to consolidate debt, or if you're looking to, and which that's also something that I, as a loan officer, have seen a lot of people doing recently, particularly because credit card debt, again, comes at a high interest rate, averaging around 20%. That's a lot higher than what you're going to pay on a HELOC or a home equity loan. So utilizing a HELOC or a home equity loan to pay off thousands or tens of thousands of dollars in credit card debt could be a smart move, because you're going to pay less interest over time on one of these loan products than what you would just having that money sit on your credit card and paying off your credit cards. So moving on from there, I said I was going to harp on it, and I am. You want to be responsible. You do not want to overspend, because it doesn't do you any good to get yourself in a bad situation by borrowing money that you can't afford to pay back. So I want to make sure that that is something that you really do strongly consider before you pull out the money, is that it is money that's going to have to be paid back with interest, and you want to make sure that you're at, I will say, a financial responsible level in your financial journey to be able to pay that money back. Because while on the lending side, we do look at things such as credit score and your debt to income ratio in terms of whether or not we can approve you for the loan or not. Ultimately, there are some people who make a lot of money, but they're really bad with money and they're really bad with spending it, and bad, even worse, with saving it. And there are some people that don't make quite as much money, but they are really good at saving, they're good at investing, they're good at being responsible with what they have. So again, this has a lot more to do with the individual rather than how much you actually make per month. But in any case, you definitely want to be responsible and you don't want to overspend. So that's pretty much it as far as it goes for the HELOCs and home equity loans. I didn't want to get too deep into the woods with all of the different criteria for it, because again, that's going to vary. I'll go back to this slide so you can see a little bit of the differences between the two as well as the similarities. But I didn't want to get too much into the weeds because some of the qualifications, again, whether you need a 660 or a 680 credit score or 700, that's going to vary depending upon the lender that you select. And some of the features, whether it's a 5-year draw period or a 10-year draw period, and how much you can take out, that's all going to be dependent upon the lender and your specific situation as well. But I did want to provide some information. Another thing that I will say in terms of being able to pull money out of your home is the cash out refinance, which a lot of homeowners may have heard of already, but I'll just briefly touch on how that kind of factors in with these two. So with the home equity loan and the home equity line of credit, these are both second mortgages that go on top of your home or on top of your primary mortgage. So you have your primary mortgage, that mortgage does not get touched. This is another loan that goes on top of your primary mortgage, and it's a second mortgage. When you do a cash out refinance, that mortgage will replace your primary mortgage and give you cash in excess up to 80% of the value of your home. So to explain that in an example, let's say that you have a home that is worth $200,000, but you still owe $100,000 on it. For a cash out refinance, in most situations, the lender can go up to 80% of the value of your home. So your home is valued at $200,000. So 80% of that 200,000 is 160,000. So you can borrow up to $160,000. So you owe $100,000, but you can borrow up to 160. So what will happen is in a cash out refinance situation, the lender will pay off your current mortgage, which is the $100,000, and they'll give you up to $60,000 more to get you up to that 80%. So 160,000 total. So that extra money, that extra 60,000 is what you would receive in cash minus closing costs, because there are closing costs that are involved with a cash out refinance, and there are closing costs that are involved with a HELOC and a home equity loan as well. So those are some costs that you will want to be aware of because those will be due up front. But with the cash out refinance, there is typically no money that you have to come to the closing table with, because they will just subtract the closing cost from the amount that you will receive in cash. So in our example, whereas you would have received $60,000 because that's the amount above the $100,000 that you already had the primary mortgage on, instead of receiving $60,000, they'll just deduct whatever your closing costs are from that $60,000, and that's the money that you would receive. So if closing costs totaled, let's say $8,000, you would receive $52,000 back in cash. And with the cash out refinance, you still have just the one mortgage. So instead of owing the $100,000 like you owed previous to the cash out refinance, now you just owe $160,000, and it's all in one mortgage. So that's how the cash out refinance works. It replaces your current mortgage with a higher balance, newer mortgage. So again, you don't have the smaller balance mortgage. We can take it up to 80% of the value of your home. And a lot of people have a lot of equity in their home now, especially thanks to the pandemic and the increase in home prices over the last couple of years. So that $200,000 home, $300,000 home oftentimes is worth a lot more. So 80% of that is the amount that a lender can go up to with a cash out refinance. So you subtract from that 80% amount however much you currently owe, and that's how much you could potentially receive in cash minus any closing cost. And you can also reach out to me anytime as well. You can follow me on Instagram or TikTok. I'm GA Loan Officer on TikTok and Instagram. I'm Frederick Middlebrooks on LinkedIn. I'm not as active on Facebook, but I do have a profile on there as well. So feel free to reach out to me if you have any questions. I'm more than happy to help, even if I'm not licensed in your state. I'm still happy to help guide and direct and provide information that can help you make more informed decisions to better your financial journey along. So thank you again for hopping on and spending this time with me. And I'm gonna hop off, and I will make sure you all get the link to the webinar. So thanks again, and you all have a blessed evening. Take care.